JPMorgan just reported $25.6 billion in net interest income. But here's the bigger question. Can JPMorgan keep growing NII as interest rates fall? That is exactly what we're unpacking today in this explainer on their Q2 2026 earnings. We're cutting through the noise and looking straight into the engine room. So that massive question, can they actually keep growing NII in a falling rate environment? That's the defining tension for the stock right now. It's the central narrative every single investor needs to figure out. Let's break down that massive headline figure. Reported NII hit a staggering $25.6 billion in the second quarter. That's up 10% year over year, keeping it right up there near record highs. On the surface, the core interest income engine looks incredibly strong.
Now you'll probably also see the headline net income, which hit $21.2 billion, driving earnings per share to $7.70. But here's the catch. You absolutely have to normalize these numbers. These Q2 results were heavily inflated by one-off items. We're talking a massive $4.6 billion net gain from Visa shares, plus another $1 billion in equity investment gains. If we want to understand the true recurring earnings power, we've got to strip that noise away.
And that brings us to $23.7 billion. This is NII excluding markets, which is up 4% year over year. For anyone tracking traditional banking momentum, this is the cleaner, far more critical metric to watch. It pulls out the unpredictable swings of trading revenues and shows us exactly how the core balance sheet is actually performing.
Section 1, the core NII engine, beyond the headline. Let's dive in.
Looking at the trend line, we've got a baseline starting in Q2 2025 at $23.2 billion, steadily climbing up to that $25.6 billion today. But pay close attention to the pacing here. While the absolute dollar amount is incredibly high, the actual rate of sequential growth from quarter to quarter is definitely starting to slow down. I mean, from Q1 to Q2 of 2026, the jump is pretty modest. It's a clear sign the environment is shifting.
To really grasp why this is happening, let's look at the underlying math. Think of it like this. Net interest income equals balance sheet growth plus asset yields minus funding costs plus mix effects. It's a delicate balancing act. When asset yields drop because interest rates fall, the bank is forced to rely on pure volume, meaning balance sheet growth, to make up the difference.
This dynamic is perfectly illustrated by what happened in Q2. JPMorgan grew its underlying income through three main positive drivers: higher deposit balances giving them a strong funding base, higher revolving balances in card services, and some healthy wholesale loan growth. But then you hit step 4, the massive offset. Lower interest rates acted as a severe headwind, literally eating right into those gains.
Real quick, if you're finding this JPMorgan earnings breakdown useful, make sure to subscribe to Fox of Wall Street, like this explainer, and share it with another investor who follows bank stocks.
Moving on to Section 2, the falling rate, headwind, and credit risks. The central narrative for JPMorgan has definitively shifted. They aren't just sitting back and riding the tailwind of high interest rates anymore. Instead, they're heavily relying on volume growth, getting more loans and securing more deposits to defend their earnings against the squeeze of falling rates. Because let's face it, a falling rate environment drops asset yields way faster than a bank can reprice its deposits. So it's essentially a race between volume and rate cuts.
But here's the thing. Growing loan volume comes with consequences. Spiking NII isn't automatically a bullish signal if it's fueled by taking on aggressive risk. In Q2 alone, JPMorgan posted a $2.5 billion provision for credit losses, which included $2.4 billion in actual net charge-offs. As those balances grow, consumer credit quality is something we absolutely have to watch like a hawk.
It really is the ultimate double-edged sword. Card services was a massive driver for that core NII growth, simply because revolving balances carry much higher yields. When consumers carry debt, the bank collects more interest. But the trade-off? Deteriorating borrower performance. We saw consumer and community banking card-related losses tick up this quarter. So yes, the yield is up, but unfortunately, so are the charge-offs.
Section 3, profitability and future scenarios. First off, you have to acknowledge JPMorgan's sheer scale and profitability. Putting up a return on equity of 24% and a return on tangible common equity of 29% is exceptional for a bank of this massive size. But remember what we talked about earlier. These metrics were heavily padded by the quarter's unusual revenue mix and those multi-billion-dollar one-off gains. You've always got to compare normalized profitability with their peers rather than just assuming this quarter's numbers are the new permanent run rate.
So let's map out what could happen next, starting with the bull case. In this highly optimistic scenario, NII stays comfortably above that $25 billion mark. JPMorgan's colossal deposit franchise and their loan demand keep growing fast enough to completely wipe out the drag from lower rates. Add in their diversified fee businesses and a strong investment banking arm, and they've got plenty of cushion.
Then there's the base case, the most likely middle ground. Here, NII broadly stabilizes right around current levels. Balance sheet growth manages to offset most of the rate headwind, but maybe not all of it. In this scenario, earnings growth starts depending much more heavily on non-interest revenue streams, backed by some incredibly strict expense discipline across the entire firm.
And finally, we've got the bear case. This plays out if interest rates drop much faster than expected, all while fierce competition for deposits forces the bank to keep their funding costs elevated, which heavily compresses their margins. If you combine that with a sudden slowdown in commercial loan demand and a nasty spike in credit card defaults, we would actually see NII start to actively decline.
Section 4, Final Investor Takeaways. Let's wrap this up.
When the next earnings report drops, please don't just look at EPS. Here is your exact checklist of what to watch. First, track NII excluding markets. That gives you the clean, traditional banking view. Second, monitor deposit growth alongside deposit pricing. You want to know if they're paying too much just to keep that cash in-house. Third, check the health of wholesale and consumer loan volumes. And lastly, keep a very close eye on those credit card loss provisions to make sure the risk isn't outpacing the reward.
So, what's the final verdict on Q2 2026? JPMorgan's core NII engine remains fundamentally strong, no doubt about it. But the overarching narrative has evolved. Balance sheet growth is increasingly being forced to do the heavy lifting that higher interest rates used to do for free. As those rates fall, their margin for error definitely shrinks.
Before we go, please remember that this explainer is for informational and educational purposes only and is not investment advice, a recommendation, or a solicitation to buy or sell securities. Always conduct your own research, and as you do, ask yourself this: can JPMorgan's sheer volume continue to outrun the gravity of a falling rate cycle, or have we finally seen the absolute peak of the NII mountain?